Welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for Verify. Today, we're going to examine the latest data on the Conference Board's Leading Economic Index, or LEI for short. The purpose of the LEI is to anticipate turning points in the business cycle and forecast changes in economic activity before they occur, which then helps policymakers, businesses, and investors make informed decisions. It's a composite index made up of the 10 leading indicators shown here. Since it's comprised of multiple components, it's able to smooth out any volatility that might be observed in any single component, and thus the LEI can provide a more stable and reliable picture of where the economy is headed. In May, the leading economic index fell to its lowest level since April 2020. The index dropped 0.5% from April to 101.2. In their latest report, the Conference Board stated that the LEI is currently not signaling a recession, but that they do project real GDP growth to slow even further, a sign that softer economic conditions are still ahead. This first chart here shows the LEI series overlaid with recessions. It's very easy to see the relationship between the two. The LEI typically declines during each recession, with the index's peaks preceding each recession, while the index's troughs occur near the end of each one. But with that being said, currently the LEI has been in decline for over 2 years straight, with the exception of February 2024, with no recession being called. And like I said at the start of the video, the Conference Board is no longer predicting one. So while the LEI has historically shown a reasonable ability to predict recessions, it's not foolproof and can sometimes give false signals, either predicting a recession that does not materialize or failing to predict a recession that occurs, like what happened in 2020. And while we're on the subject of recessions, let's take a look at our next chart, which offers a little bit more insight into the relationship between the LEI and recessions. Here we see the percentage off the previous peak for the index, which refers to the amount the index has fallen from its highest recorded level at that time. We're currently 14.1% off the most recent peak from 2021. In this chart, we can also see the number of months between a peak and the official start of a recession. On average, there's usually 10.6 months between a peak and a recession. This has ranged from as little as 1 month back in the 60s to as high as 20 months in the lead up to the Great Recession. Currently, we're 29 months from the 2021 peak, well above the average and higher than any other lead into a recession, which is just another example of how current economic conditions are unlike any we've seen before, and traditional recession indicators, such as the LEI, are not infallible. To further enhance our use of the LEI as a gauge of recession risk, we can tighten our recession lead times even more by plotting a smooth 6-month rate of change, as shown here in our next chart. The latest smooth 6-month rate of change is at negative 2.5%, above the negative 4.2% trough that occurred last summer. And as you can see from our call out in the bottom left corner, the LEI has historically dropped below its 6-month moving average of the 6-month rate of change anywhere between 2 to 15 months before a recession. Currently, the LEI has been below its 6-month moving average of the 6-month rate of change for 23 months. Again, well above any other lead time to a recession. But as you can see, there have been times where the LEI has been below the 6-month moving average of the 6-month rate of change for multiple months without a recession being called. And to further eliminate whipsaws, here's a 12-month smoothed out version. The latest smooth 12-month rate of change is at negative 6.8%, above the negative 7.5% trough from the beginning of this year. Again, you can see from our call out in the bottom left corner, the LEI has historically dropped below its 12-month moving average of the 12-month rate of change anywhere between 9 months before a recession to 5 months after the official start. And currently, the 12-month moving average of the 12-month rate of change has been negative for 17 months, almost twice as long as any other lead time into a recession. Yet another example of how current economic conditions are not playing by the history rulebook. In the Conference Board's monthly update, they also include their Coincident Economic Index, or CEI, which measures current economic activity, and it's only made up of 4 components. This chart here includes both our CEI and the LEI. Observations show that when the leading economic index starts to decline, the coincident economic index generally continues to rise. For example, the LEI has declined or been flat since April 2022. Over that same time frame, the CEI experienced only 4 monthly declines. In May, the coincident economic index rose to an all-time high of 112.4. In May, the coincident economic index rose to an all-time high of 112.4, marking a 0.4% increase from April. Now, to close out, I want to present one last chart, which shows the LEI CEI ratio. This is perhaps a leading indicator of recessions if you count the lead time as the number of months the ratio has been declining prior to a recession. The LEI CEI ratio has now declined for 26 consecutive months. However, as you can see from this chart, there have been times where the ratio has declined for several months without a recession, which is why I prefaced with this ratio being a possible leading indicator of recessions. That's all for our discussion on the Conference Board's leading economic index. Thanks for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.